Thank you for being here in presence as well as online. I hope the connection is working properly. It is my great pleasure to open our conference on experience ratings in insurance markets, which is a very hot topic, you know, in literature as well as in the practice. In fact, we have divided our conference into two parts. One devoted on literature, more academic, and the other one in the afternoon on the practice of insurance markets. As you know, we have a very intensive program. So I give the floor to our president, Luigi Federico Signorini, for his presentation of the conference here. Thank you.
Thank you, Riccardo. Ladies and gentlemen, it's a great pleasure for me to open this workshop. As the title suggested, its aim is to discuss recent theoretical and empirical advances in economic experience ratings in liability insurance, with a view to contributing to the current debate on possible reforms of rules and practices in Italy, as Riccardo just said. In my introductory remarks, I shall focus on the case of automobile insurance, by far the most important in quantitative terms and the main focus of public debate. However, the lessons we shall learn today are likely to be relevant for other cases, such as that of health insurance. Let me start by briefly characterizing the Italian motor third-party liability insurance, or MTPL. Like in most other countries, it's a large market. As insurance is legally compulsory for most vehicles, the vast majority of households and firms, therefore, need to buy it in some form. Therefore, its cost and its ability to serve its purpose in an effective and a transparent way have a non-negligible impact on welfare. In 2021, 43 million vehicles, of which 32 million cars, were covered by insurance. 2 million claims were filed, 14.5% of them involving bodily injuries. Historically, car insurance has been more expensive in Italy than in comparable European countries. However, premiums have come down significantly by 30% in nominal terms over the last decade. Several factors have contributed. Increased competition, helped by rules making the mobility of customers easier, has put pressure on margins. Specifically, it has reduced market segmentation, thus compressing abnormally high margins in some local markets. The incidence of fraud has also been reduced, not least thanks to the deployment of a common database of claims managed by IVASS that makes it possible to detect suspect patterns and conduct cross-checks of potentially fraudulent claims. New legal rules on compensation have reduced uncertainty about the value of awards for physical damage. The gradual spread of black boxes is likely to have encouraged more careful driving by those who have adopted it. Quite possibly, improved road design and maintenance may also have enhanced safety. I think we can legitimately say that honest and prudent drivers now face, on average, a better deal than they used to. With all that, gaps remain. Both the average premium and the average claim costs are still higher in Italy than in other major European countries. Within Italy, geographical differences remain remarkable. Despite the fact that the premium differential between the cheapest and the most expensive province has been reduced by almost one-half since 2014, there still is a significant geographical segmentation in both accident frequencies, which range from 3 to 8%, and average premia from 254 to 528 euro. There is therefore quite some way to go, especially if one considers the pressure that inflation is now putting on settlement costs. A new instrument for comparing competing insurance offer, or preventivatore in Italian, is now in place. Italian. I'm not sure that this is actually an Italian word. It's a made-up word for this particular tool. It is meant to increase the transparency and contestability of the MTPL market. We expect insurance companies to implement it in full and customers to make good use of it. Also, the rules about compensation for bodily damage are being further enhanced. Looking further ahead, there is room for improvement regarding, I think, two major issues. The first issue is compliance. While reliable and precise statistics on delinquency rates are hard to come by, it is estimated that about 6% of drivers are not actually protected by legally mandatory insurance. Since damages caused by uninsured and insolvent drivers can be covered by a solidarity fund paid for by the insurers, the inherent cost is ultimately reflected in premia, and therefore it weighs on law-abiding drivers. Mandatory car insurance is necessary to avoid adverse selection and harmful externalities, and is therefore enforced in most jurisdictions. An enhanced effort to prevent non-compliance is surely warranted. We believe, furthermore, that the potential effectiveness of such an effort is actually growing thanks to advances in mobility information technology. The second issue is better pricing. Policy pricing should reflect the actual riskiness of drivers and reward prudent driving. It is here that the experience rating enters the pictures. Participants in this workshop are surely well aware of the subtle and sometimes counterintuitive issues surrounding the matter. There are few fields, I think, where sound theory and econometrics can be of greater help in setting practical, real-world rules and practices with a view to improving market efficiency. In Italy, as in other countries, a certificate of policyholders' driving record, or attestato di rischio, contains information on the history of individual claims. It follows the policyholder when he or she switches company. The certificate specifies a risk class based on history, as well as the number of at-fault claims in the previous 5 years. This information is used to adjust the price of insurance and to reduce moral hazard. Estimates show that on average, an additional at-fault claim increases the premium by 27%. However, since accidents are fortunately rare, the current experience rating system is insufficiently precise, in that most people are concentrated in a single risk class. In the second quarter of 2022, 87% of policyholders belong to the best class, and 89% had no at-fault claims on record for the past 5 years. This results in too much heterogeneity within the top risk class. Class-based premia, in other words, do a poor job of approximating individual true expected claims. Better pricing and incentivizing tools would surely be welcome. It is then logical to ask whether or what additional information would have the potential to improve premium fairness. That might include items such as the number of traffic violations, the severity of at-fault claims, the sojourn times in a risk class, etc. Experience rating, of course, is not the only possible set of tools. Other potential risk-sharing mitigation tools include deductibles, mileage-based charges, mandatory alcohol ignition locks, and much else. Still, many of us believe that experience data could be exploited in a more efficient way. It is not necessarily a straightforward task, and it does need rigorous economic reasoning. This morning, Jean Pequet will present a paper that highlights the effect of adding traffic violation and penalties to the traditional information about claims history. Corina Constantinescu will describe the methodology for including claim severity in the calculation of premium. A further possibility discussed by Yi Xin is monitoring not only actual accidents, but also near misses. The implications of doing so are not obvious, example. Does a near miss suggest inherent carelessness, or may result in enhanced risk awareness, hence more prudent behavior in the future? You'll hear the answer. An even subtler issue has to do with the information on driving habits recorded by monitoring devices such as the so-called black box. The paper by Jean Izzo offers valuable insights into the issue of whether portability of black box data would improve welfare. The answer, once again, is nuanced. As another example of the theoretical difficulties implied in pricing schemes, our colleague Marco Cocconati's paper highlights certain possible counterproductive effects of penalties enforced by potential and current insurers if coupled with price walking strategies. A final difficulty, let me add, is that the two big issues we face, compliance and risk sensitivity, are connected. The more risk sensitive the premium is, the fairer the pricing becomes in actuarial terms. But at the same time, the incentive for non-compliance also becomes stronger because of adverse selection. Even as things stand now in this country, elevated geography-based premium in some provinces appear to be associated with the higher prevalence of evasion. While enforcement must indeed be made more effective in order to produce a superior outcome in terms of welfare and in the interest of honest and prudent drivers, there may be limits to what enforcement can realistically achieve with given resources. If a strict risk sensitivity produces, in some cases, premium levels that are so extreme that they effectively price out certain drivers, relying on enforcement alone may be illusory and, some might argue, even unfair in some non-technical sense. One more trade-off to reflect on. This morning's academic discussion will provide useful insights for the second part of our program, where industry representatives and authorities will debate on possible directions for reforms. On our side, and given our statutory responsibilities, we intend to pay the utmost attention to any sensible proposals and observations. Turning to our academic program, it's now my pleasure to introduce Professor Fang Hanming, who kindly accepted to give a plenary lecture on the topic of the workshop. Professor Fang is the Joseph M. Cohen Term Professor at the University of Pennsylvania and the acting chair of its economics department. His remarkable scientific contributions span a wide range of subjects, from public economics to labor economics, through economics of information to the economics of insurance. For his work on insurance economics, he was awarded the 17th Kenneth Arrow Prize by the International Health Economics Association, together with Mike Keane and Dan Silverman. He's also known, by the way, for his role in stimulating independent research on the Chinese economy. Before leaving the floor to Professor Fang, let me express my gratitude to all members of our distinguished panel speakers, and thank all participants, including those that are following us online. And also let me extend my thanks to Riccardo Cesari, Marco Cocconati, and the other person who have contributed to organizing this very good seminar. So I wish you all a fruitful and enjoyable discussion. Thank you.
Okay, so good morning, everyone. Thank you, Mr. Signorini and Mr. Cesari for the introduction, and thanks, Marco, and many organizers here for the invitation. It's my great honor to present some work here that's related to insurance in general, but I will be talking about a topic related to health insurance, but I will make connections to automobile insurance as well. Mr. Signorini said that what discussion happening here on automobile insurance might have implications about health insurance. I'm going to do something in reverse. I will talk about health insurance, but hopefully it will draw some implications about automobile insurance. So Not only the, the topics about health insurance, the setting that I will be studying is also Germany, a little bit north from Italy. So it's joint work. It's based on joint work with my colleague Juan Pablo and at Penn and Martin Carlson at Duisburg, Eisen, and Nicholas Zebath now at Mannheim. How do I advance there? Okay. Okay. So let me start out by just drawing some distinctions between automobile and health insurance, right? So on the left are the, the famous Italian automobile brands that I can find, and right, obviously, the picture of a doctor. Okay. So what are the key differences between automobile and health insurance and health insurances? Let me start with some similarities, right? In both insurance markets, there is a very large cross-sectional heterogeneity in risk. Individuals differ in their risk, okay? And at the same time, there is also very noticeable and well-documented life cycle heterogeneity in risk, right? How the life cycle heterogeneity in risk evolve over time do differ substantially between automobile insurance and health insurance. I will draw that out in the next slide. And there are also major concerns about moral hazard in the idea that insurance, having insurance itself, or having the kind of insurance one has may change the risk realization. Okay, Marcos and several other papers in the program will speak to this in the automobile setting. And the topic I will focus on today is the fourth similarity between automobile and health insurance, in the sense that all of the contracts we know about are annual contracts, right? And the question we will ask is, why annual? Right? What makes 1 year, 365 days so unique? Maybe we should be thinking about long-term health insurance, long-term insurances, right? So, but the reality on the ground is that contracts tend to be annual, right? Pricing of the contracts are annual. Policyholders are therefore subject to what's in the insurance literature known as reclassification risks, meaning that your risk will be reclassified from year to year, and which will affect your premium. Okay. Now, why does that matter? Well, we need insurance because we are risk averse. We don't like risk. We don't like being reclassified. If the premium is changing from year to year, that's a risk that insurance company should be in the business to insure the consumers about. And precisely because the contracts are annual and the risks are reclassified every year, consumers are inevitably being subject to these reclassification risks. The paper I will be presenting today will be proposing that there is a better way of doing that to provide not only insurance against the contemporaneous risk individuals are experiencing, but also provide reclassification risk insurance through the form of long-term contracts. Health insurance setting in Germany, there is long-term private health insurance. Automobile insurance, I haven't seen any long-term automobile insurance yet. The question is why? Is there some way to bring in long-term health insurance to improve actually market outcomes? Now, the fifth similarity I want to draw out is that both industries are experiencing a lot of technological innovations. The papers in the program today will be talking about telematics, these black boxes, and so on in automobile setting. But in health insurance setting, there are more and more health monitoring apps. More of our health habits and health indicators are being recorded digitally by various apps. How will these things affect the operation of the health insurance in both health insurance and automobile insurance, right? And for automobile insurance, I would imagine there's also even stronger, larger kind of challenges coming from the emergence of self-driving vehicles, right? The whole market, I think, is at the dawn of significant changes in the years to come. In the next 15 years, as more and more cars become self-driving, how would the risks be evaluated? These are challenges that I think it's a great time for the industry, for both academics and practitioners industry to think about. So these are the similarities. What are the differences? The first key difference I would say is that the life cycle risk patterns really differ significantly between automobile risks in the automobile insurance sector and the risks in the health insurance sector, right? Health insurance, we know that older folks have higher expected medical expenditure, though infant years have somewhat higher medical expenditure than, right? But for automobile insurance, from legal driving age onward, the risk declines over one's life cycle and only picks up at the very old age, right? So if you, this is the typical kind of life cycle risk profiles for auto and health insurance. And this turns out will have significant implications regarding whether long-term health, the kind of designs that I will talk about in terms of long-term health insurance setting, could be applicable to the automobile setting. I think there are ways to organize long-term automobile insurance to draw in. So what happens is that because automobile insurance, the risk is higher for the younger age, right? And the younger age individuals, actually suffers from high premiums. And if Marco was telling me that, in Italy, for example, only 2% of the policyholders of automobile insurance are from 18 to 20, right? The younger age cohort. So maybe there is a way to bring down the insurance premium for the younger drivers using long-term health insurance, long-term automobile insurance. Of course, insurance companies would have to be willing to do that. So I will explain the economics or the actuarial principles behind long-term contracts in my talk. There are other differences. Outside options really differ between automobile insurance and health insurance. So with automobile insurance, what's the worst you can do if your premium is really too high? Well, you end up, right, living without a car, using public transportation, taxi, etc. For health insurance, that's not an option, right? So maybe that's, the different outside options between auto and health insurance can go a long way in explaining the very different attitudes we have regarding auto and health insurance. The moral hazard also differ quite substantially. For health insurance, there is both the ex ante, interim, and exposed moral hazards, right? Ex ante meaning that individuals may have different incentives to prevent health, to undertake exercises or preventive care, etc., to lower the risks of health shocks. And interim moral hazard refers to the idea that when you do experience a health shock, right, how much care you would purchase will depend on how good insurance coverage you have, right? So the ex ante refers to the incentive to prevent the risk from happening. Interim moral hazard refers to the incentives to get more or less care depending on your insurance contracts once the health risk already emerged. And exposed risk is really about claims. Even after having undertaken the fixed amount of care expenditures, you may or may not decide to submit a claim to the insurance company depending on the contract. And in health insurance also, there are more than just the consumer themselves. There's also the healthcare provider side, right? They also have moral hazard. Physicians have financial incentives that will affect how much care they will prescribe to the patients depending on the insurance contracts the consumer have. For automobile insurance, the ex ante moral hazard seem to be the main moral hazard in question. The pricing regulations differ drastically. In health insurance, in Italy, there is a national public health insurance, but even in US, for example, there's not a single national health insurance, but the regulation is really pushing toward community rating. The idea that your insurance premium should not depend on your health insurance premium, should not depend on your experience rating. The whole theme of today's conference is experience rating. Community rating is the opposite of experience rating for health insurance setting. We would, in health insurance, we don't want individuals' health insurance premium to go up and down depending on whether they have a particular health episode. In automobile insurance, experience ratings seem to be rather prevalent, right? And indeed, in health insurance, there is a push toward social insurance, spread the risks across the whole population. In automobile insurance, however, as far as I know, there's not a single country in the world where automobile insurance is provided socially, right? So I just want to tease you in terms of a few things that I thought may make you feel like, okay, there might be some lesson to be learned from the health insurance setting I will be talking about for the automobile insurance that most of the attendees here are interested in. So with this, let me just go to the some of the how does long-term health insurance work in Germany. So this is actually a real-world picture. A group of 5 college friends have been taking group pictures every year, with the exception of 2020 during the first year of COVID. They took pictures everywhere and they posted online. This was pictures I took from New York Times. From 1982 till 2022, like I said, with the exception of 2020, the first year of COVID. So you can see that as one age, the individuals, the fittest or the skinniest individual at the young age may end up being the least healthy individual at the older age. There are a lot of risks that individuals experience in terms of their health risk over one's life cycle. So how do you kind of, so if you have annual premium, right, what will happen is individuals' premium will really be a function of their current health, and because current health is very stochastic, very unpredictable, so individuals are subject to many of the risks. The premium may go up or down depending on whether they have a particular health episode, whether they have an accident in a skiing trip, and so on, right? So how can insurance companies provide insurance against such recalculation risks? Okay, so let me just give you, I will illustrate the main insights of the long-term health insurance contracts in Germany through some simple examples. This is a very simple example. Think about a 2-period model, where in the first period, individuals have some medical expenditure. Their health risk is low risk. So L indicates low risk, H indicates high risk, right? So the first period, individuals are all healthy, 22-year-olds, right? They have some medical expenditure denoted by EML, expected medical expenditure, in the first period when the individuals are low risk. In the second period, when they enter the middle age, there are 2 possibilities. The first possibility, with the probability P, they remain low risk. With the probability 1 minus P, they become high risk, right? The medical expenditure will be EML or EMH in the second period, depending on whether there's a change in the reclassification of the risk. So if you buy low insurance premium, so let me just put the numbers, right? The low risk individuals' medical expenditure is $1,000. High risk medical expenditure is, on average, is $4,000, right? So that's the setup. Now, if you buy short-term contracts, what will happen, right? If the contracts are all annual, in the first period, the expected medical expenditure is $1,000. Insurance companies compete for the consumer, subject to some loading factors, some administrative costs, right? The premium will be $1,000, right? Assumes 0 loading cost. In the second period, the premium will be either $1,000 if the individual remain low risk, or $4,000 if the individual become high risk. You see, if it's annual contract, in the second period, individuals are being subject to a risk. The premium could be $1,000 or $4,000. If you are risk averse, you don't like that. Should an insurance company is in the business of, they spot risks, and they try to think about insurance products to provide insurance against that risk, right? And earn some premium, some normal profits in the process, right? So short-term contract is subjecting individuals to this high variation in the second period premium. And how do you, so now the question is, how do you do that? How do you provide insurance against individuals' second period insurance premium fluctuations without, insurance company losing money? Okay, so so this is, in words, what I just said, right? Short-term contract expose policyholders to potentially large premium fluctuations, also known as reclassification risk. And a Nobel laureate Peter Diamond in 1992 Econometrica presidential address actually argued that the lack of insurance against reclassification risk in health insurance setting is a major source of welfare loss in the U.S. In the United States. Okay, Now, how do you, suppose that one possible policy response is the following. In the second period, the premium could be 4,000 and 1,000. What if you just impose a community rating regulation in the second period? Say your second period premium cannot depend on whether you are low or high risk. Okay, so what will happen? Well, second period, with 50% chance the medical expenditure is 1,000, with 50% chance the medical expenditure is 4,000, average $2,500. What if the community rating says, okay, your premium in the second period cannot depend on whether you are low or high risk. Instead, it should be the same premium for everyone at $2,500. The problem with this is, well, the individual with the low risk of 1,000 may not want to buy it. Right? The 4,000, the high-risk individual is really happy that they got a premium in the insurance contract in the second period with a premium of only $2,500. So the low-risk are not happy. They drop out. They say, look, I'm not going to buy this premium at $2,500 in the second period because it's much higher than my actuarial fair premium of 1,000. That is basically the adverse selection problem. Okay? A community rating will lead to adverse selection. So what is a typical policy response? To deal with this, you need to do individual mandate. You say, look, yeah, the 1,000 low-risk individuals do not like the $2,500 premium in the second period, but, you have to buy it through mandate. But mandate is very controversial. In the U.S., in fact, there has been Supreme Court challenges that challenges the individual mandate in so-called Affordable Care Act, right? So now, what about another idea? This is an idea of called the guaranteed renewable contracts by Mark Pauly, my colleague at Wharton. So Mark Pauly in 1995 proposed a guaranteed renewable contract that works as follows: in the second period, everyone will be getting a premium of $1,000. Okay, the lowest risk individual's premium is 1,000. Second period, the premium will be 1,000 for everyone. Okay, but in the first period, insurance company cannot lose money. So insurance company would have to be charging in the first period enough premium, front-loading premium, right, in the first period to guarantee, break even, right? So how do you guarantee the break evenness? Well, in the second period, if the premium is 1,000, the insurance company will be losing money on those high-risk individuals, right? High-risk medical claim will be 4,000 on average. They are only paying $1,000 premium. So each individual, the insurance company will, each high-risk individual, the insurance company insures, the insurance company will be losing $3,000, and 50% of the individuals in the second period are high risk. So they are losing about, $1,500 in the second period on average. And that $1,500 would have to be added to the first period premium, so-called front loading, right? So the first period, the premium will be $2,500, and then in the second period, the premium will be $1,000 for everyone, and that can break even. That's Pauly's guaranteed renewable contracts. Okay, that's not the German long-term health insurance contract, right? But it's a plausible long-term contract that can break even for the insurance company, and it provides. There's no premium fluctuation in the second period. Everyone in the second period gets $1,000 premium, but it involves a lot of front loading in the first period. Okay. Now, another idea of providing reclassification risk insurance is to use long-term contracts. Long-term contracts typically leverages individuals' private intertemporal incentives. Right, community rating, you can think of it as forcing individuals to of low risk in a given period to provide insurance against individuals in the same period of higher risk. Right, it's cross-sectional risk redistribution. Long-term contracts generate something called intertemporal redistribution. So when I'm young, right? So let me just give you the example here. Okay, so I will come back to that in a second. The idea of long-term insurance contract is basically when you are young, right? You have low risk, and you front load a little premium when you are young, and in return, the insurance company commits not to raise your premium when your risk goes up. Right? So individuals will be risk rated when they first sign up for the long-term contracts. But after that, in subsequent periods, the premium will not go up. It can only go down. If your risk becomes lower, your premium can go down, but it will never go up. So individuals are now protected to a large extent against the reclassification risk, right? So that's basically the idea of long-term health insurance, basically long-term contracts that basically provides reclassification risk insurance without the need of individual mandate, right? Because initially the risk rating is permitted. So I will basically give you the idea of how it works in Germany, right? In Germany obviously has a national health insurance, statutory social insurance, but actually 10% of the German population were allowed to opt out these statutory social insurance and buy private long-term health insurance from the market. Okay, how does that work? At the initial let me see. Okay, here at the initial enrollment, right, the medical underwriting is permitted. Right? Individuals will do a medical exam when they first sign up on the long-term health insurance. The premium will be risk rated. Pre-existing condition clauses are allowed. Determined individuals may say, look, I have some pre-existing condition. I would like my contract to exclude the caring for these pre-existing conditions, but it's very rarely used. There's no guaranteed issuance at the initial, at the inception, but there's guaranteed renewability in future periods. In subsequent periods, there's a principle of constant guaranteed premium, right? The premium in subsequent periods will not depend on whether you become healthy or unhealthy, okay? And there's one-sided commitment. The insurance company commits to this long-term contracts. The consumers can opt out if they have a better contract to get from the other insurers, right? So that's basically the German long-term health insurance plans. Let me give you, so in math, I will only have a couple equations, just very simple notation. At inception, suppose individual goes to buy insurance contract, long-term health insurance contract at age t, little t, when his health is zeta t, okay? Health status is zeta t, that's the risk category. I will explain a little bit later on as well. The insurance company will offer a premium, PT of zeta t, that's guaranteed premium for this individual for all future periods if the individual want to renew the contracts in future periods, right? This PT zeta t is the initial risk-rated premium that's guaranteed premium for the individual throughout the duration of the contract as long as the individual want to renew, right? The individual may, however, decide to lapse. If they see a lower premium later on in future periods, right, they can lapse. So lapse is possible in period tau, which happens after the initial enrollment period of T, if the policyholder can get a lower guaranteed premium, P tau of zeta tau, right? In future periods, his health status may change to zeta tau. If P tau of zeta tau is lower than the initially guaranteed premium, the consumer can lapse, okay? But how does the insurance company break even? So let me give you the example here. This is the Pauly example. Let me go to the how does the German long-term health insurance contract works, right? Same example, right? The German insurance contract will work as follows. The initial enrollment at the time t equal to 1, the individual's expected medical cost is 1,000. The insurance company will say, I will guarantee you a premium of $2,000 for as long as you are willing to renew the contracts. In the second period, individual can either stay with the contract, long-term contract, at the premium that was pre-specified at period 1 of 2,000, or the individual may go to the spot market and say, look, I can get a better contract in the second period, right? So in this particular case, the low-risk individual in the second period will say, look, the long-term contract premium of 2,000 is too expensive for me. I can get a better deal of $1,000. The high-risk individual with the medical expenditure of 4,000 is very happy with the $2,000 premium. He stays. How does that break even for the insurance company? Well, the insurance company is losing money of $2,000 in the second period on the high-risk individual, right? Which is 50% of the market, right? So $44,000 minus $2,000, that's $2,000 loss on the high-risk individual in the second period. There's only 50% of the market is a high risk. So on average, the long-term contract will lose $1,000 in the second period. But the second period, the first period premium is front-loaded with with $1,000 more than the first period actual claims, right? So the first period $2,000, second period guaranteed renewable premium at $2,000 will actually break even. And what happens is that the high-risk individuals in second period will stay with the long-term contract, pay a premium $2,000. The low-risk individuals lapse their long-term contract that they signed in first period and go to a spot market contract of $1,000 and it breaks even. That's the German long-term health insurance contract. It differs from the Pauly contract. Pauly contract has more front-loading, but no fluctuation premium at all in the second period. Okay, the question then is, which one is better? Is the German long-term health insurance contract better than the Pauly ones? Or there's even another contract which is optimal one, but I will explain that later on, okay? So mathematically, this is accounting for lapsation. This is the determination of the first period guaranteed premium, okay? I'm gonna skip these mathematical details. Like I said, there's also a recent paper talking about the optimal contracts. And the optimal contracts will actually guarantee consumption levels. I will explain that in a second as well. Okay, so this is the German long-term health insurance contract I already talked about. What is the optimal contract? Optimal contract, it turns out, in this example, if the income in the first period is $10,000 for the individual, and in the second period is $12,000, or euros here, okay? What happens is that the optimal contract will say the first period premium will be $1,333.3. In the second period, this is, in the second period, the premium will either be $1,000 or $3,333. So this is the optimal contract, okay? And this can also break even. If you do the mathematics, this contract, the optimal contract also breaks even, right? The second period, the insurance company is losing money, about $667 on the high-risk individuals, and with 50% chance, and that expected loss in the second period will be compensated by the front loading of $333, okay? Short-term contracts, in terms of consumption level, under the short-term contracts, you have very big variations in the consumption level in the second period, right? The premium was $1,000 in the first period, income is $10,000, so the first period consumption is $9,000. In the second period, the income is $12,000. The premium under the short-term contracts will be either $4,000 or $1,000, depending on risk realization. So the consumption will be either $11,000 if you are low risk, right? $12,000 minus $1,000 premium, or $8,000, which is $12,000 minus $4,000, right? So there's large fluctuation in consumption in the second period, and that consumers don't like, and there's welfare loss from this consumption fluctuation. Under the Pauly contract, the first period consumption will be $7,500. In the second period, consumption will be $11,000 because the premium in the second period is $1,000 regardless of your risk realization. Okay, no, there's no okay. So German contracts, the implied consumption level is this, and the optimal contract implied consumption level is this. So the rest of the paper basically try to evaluate, compare these four different contracts: short-term contracts, Pauly et al. Contracts, German long-term health insurance contracts, and optimal contracts. What we found was that, surprisingly, the German long-term health insurance contract, despite theoretically being not necessarily optimal, it achieves almost all the welfare gains one can get from the optimal contract. Okay, so I will probably running out of time. I will say one more thing about how to model health risks. That's kind of relevant for the discussion we have here, right? So Mr. Signorini was saying, what should one include in the risk rating, right, for the automobile insurance setting? Similar things happens similar issues arise in the health, in the health risks, right? So Mr. Signorini said that, in Italy, 87% of all the policyholders for automobile insurance are now in the best risk category, right? Now, the question is can the risk category be optimized? How do you categorize risk to be optimized or not? So it turns out that in health insurance setting, there's a similar issue. Individuals' expected medical claims, of course, differ drastically. There is actually a wide distribution of expected medical claims based on the past health records, right? It is a continuous distribution. But insurance companies don't like to work with continuous risk categories. They actually want to kind of discretize this continuous range of risk categories into a small number of discrete categories. What's the best way to do that? In insurance setting, there turns out to be some well-known principles, right? So this is the idea. So there are many different a continuous distribution of risks, and in the interval from lambda t man lambda the variable lambda star is a continuous measure, and you want to map the continuous measure into a discrete category lambda t without star, right, which only has k categories. And so the lambda star is this continuous variable. Lambda t is risk category 1, 2, 3, or 4, those discrete categories, okay? How do you do the mapping? So insurance actually has these principles called homogeneity and separation. Homogeneity means that individuals in same risk category should have similar risks. Separation means that categories should be sufficiently different in the form of expected claims to warrant distinct categories. If two individuals differ only slightly in the expected claims, you don't want to put them into two different categories, right? So my understanding is that right now the experience rating, the bonus malus experience rating system in the automobile setting is based on just counting the number of at-fault accidents, right? There's not necessarily, conceptually, it's not necessarily the case that this mapping, how do you map the number of accidents into risk categories is automatically the way it's being practiced, right? You count the number of at-fault accidents. So machine learning is another thing that's going to impact the industry. So it turns out the efficient risk categorization will boil down to what is known in the machine learning literature, something called k-means clustering, right? So there are continuous risk measure lambda star. How do you put these, map these lambda star measures into k categories? Say k is 3 or 5, right? What's the best way to do it? The actual literature actually proposes a method that I write here, and if you look at the formula, it actually is identical to what is known as the k-means clustering problem in machine learning. So maybe that's one thing that could have some cross insurance sector kind of implications. And so if you want to have 5 risk categories, how do you do the risk categorization? It doesn't, coming back to this picture, if you want to do 5 risk categories, one possible way is just do the 5, equal spaced, right? Divide the lambda star into 5 equal spaced intervals, and then call the left interval as category 1 and the rightmost interval as category 5, for example. That's not the efficient thing to do, right? According to the actuarial principle. And there's another common practice was just instead of equal space categorization, another approach is to do equal sized categorization. So each risk category has same number of policyholders. None of these are efficient. Neither of these should be the efficient risk categorization. The efficient risk categorization should be doing something called k-means clustering. Okay, so I will conclude actually. Now I still didn't give you the answer. What the German long-term health insurance contract, is it doing well or not? So I will skip the details, but let me just tell you the bottom line. in general, right, basically relative to the optimal contract, the German long-term health insurance essentially attains about 96 to 97% of the welfare gain of what a optimal long-term contract could have achieved. The welfare loss in the real red numbers of German long-term contract relative to the optimal contract is in the range of 3.5% or 3.9%. Not much welfare loss, even though it's known to be not optimal. But it's very simple to operate. Germans have been doing it for close to 100 years, and it turns out to be quite efficient relative to the optimal contract. So let me actually summarize here. I kind of give you the idea of how the German long-term health insurance contract works in the insurance setting. It's a very simple design of long-term insurance contracts. It turns out that it comes very close to optimal contract in terms of welfare. It performs remarkably well, between 0 to 7% of welfare loss compared to the optimal contract. Huge welfare gains relative to the short-term contracts. Okay, and can long-term health automobile insurance work? I took this opportunity to think about the implications of health insurance and automobile insurance. These two insurances often are considered very separately. I feel like there should be a unified way of thinking about this. So what if you offer a long-term insurance contract, long-term automobile insurance contract to the young drivers when they first get their license? Well, they have high risk. A lot of them become either go without a car, or they may go without insurance, right? Even though there's mandatory insurance, Mr. Signorini said that 66% of them are not actually in compliance, right? And also a lot of the young people don't have an automobile. Okay, so in order to draw in more of the young drivers in the insurance pool, you need to subsidize these individuals, right? Because their premium is too high. You want to subsidize them, and their risk will get lower over time. The insurance company will be happy to do that if the young drivers can commit to stay in the same insurance company, right, and enjoy the initial premium subsidy, and later on, when they become less risky, they pay. Right, and as they become more experienced drivers, they become less risky. They will pay a little higher premium than their actuarially fair premium. The problem is how do the consumers commit not to switch to a different insurance company in older ages? So there has to be some kind of non-renewal fees specified in the contracts. If the long-term automobile insurance contract were to be something of a practice, to bring into the marketplace, there is hope to basically, you sign up, right? The insurance company sign up the young drivers when they are risky, offer them a low premium, but the contract also specifies that you need to remain in the same insurance company when you get older. If not, there'll be some cancellation fee. Okay, and that could be, in my view, the analog of long-term health insurance contract in the automobile setting. So I will stop here. I'm almost close to my last second. So thank you.
Maybe I'll start with my own question. The idea of long-term contracts, at least at first sight, it does solve the issue of adverse selection. But how about moral hazard? I mean, if you are bound for life to a fixed contract, doesn't that have an adverse effect on your own behavior, the behavior that can influence your actual risk?
Right. So there's always this. That's a great question. As you, the paper that I just presented completely ignores the moral hazard issue, right? The guaranteed premium, provides insurance against reclassification risk, but also it removes the incentives for individuals to improve their health. In the automobile setting, it also removes the incentive for individuals to drive more carefully and so on, right? So the moral hazard issue. So for health insurance, as I mentioned, I feel like moral hazard is not as important, at least for the, especially in settings where in health insurance setting where the other side, the healthcare providers actually is the one that controls how much expenditure that will be incurred after some health realization. For automobile insurance, I think it's a more serious issue. The moral hazard, I always felt like, you know, there might be technological solutions to address the moral hazard issue for automobile setting, right? As it's in some sense, you know, with the technology. So a lot of the individuals being careless in driving and so on might be less a significant issue as the technology is able to assist individuals to, you know, stay alert. But they don't even need to stay alert when the system, right, onboard system can help them, you know, avoid obvious mistakes and so on. So maybe that's the reason long-term automobile insurance, it does not exist yet because of the moral hazard issue. But there is a chance that the technological innovation that I previously talked about might, you know, overcome the moral hazard issue in a way to make the long-term automobile insurance more sustainable. Yeah.
Microphone.
Subsidize the individual when they are young, which is very similar to what we have in Italy, I think, because in the case of young, you have the risk class of your father. So it could be, in a sense, a provision which comes similar to your suggestion, I think. Okay. I don't know in other countries if there is a similar.
Okay,
in
so
Italy, it is
how do the insurance companies make sure, without long-term contracts, how can insurance companies make sure that the young workers, young drivers who, you know, inherently have higher risks, you know, how would they break even? The insurance companies are doing cross-subsidization across different
I think so.
age groups? Okay. Yeah.
Any other question?
For switching is suboptimal because lack of committing, but switching also pushes premium down because of competition. So, you know, the inability to commit on the other hand is good because insurers still customers each other and that pushes premiums down. And when you prevent that from happening, you know.
Right. Okay. So that's a great question also. And the competition still actually is in operation in the long-term contract. The competition will all be loaded at the initial enrollment stage, right? So when the consumers are deciding to sign the long-term contracts, they shop around many insurers, and they will try to get the best deal from the you know, get best quotes from the insurers they talk to. So there is competition in the initial enrollment. After that, they have to commit to the contract they signed on. So you may say that this does provide some bad incentives on the insurance company side, that once the consumers are locked in, they may start to provide worse services. But since there are a lot of insurance industry people here, I doubt that ever happens. I'm just joking. You know, insurance companies, I think they will compete for the, you know, there are always young, you know, young drivers coming to the market. They want to maintain good reputation, and I think the competition and the post, you know, service will also, you know, be maintained at high level to ensure that they have a good reputation to attract more new young drivers to sign the long-term contracts. Thank you.